Today, I'm going to teach you the top 4 strategies to minimize taxes on your investments. This question actually comes from my Discord where someone asked, how can I reduce or avoid taxes on my financial gains? It's a great question because making money is hard, but many people just end up giving it away to the government when they don't know these strategies. Okay, listen, this is not an exaggeration. A few clicks of the mouse could save you thousands or even hundreds of thousands of dollars in taxes over your lifetime. Let's dive in. The number one strategy to minimize taxes on your investments is to take advantage of tax advantage accounts like IRAs and 401ks. As a simple example for illustration purposes, let's compare 2 people who are both 30 years old, work at the same company, and make the same amount of money. We'll call the first one Smarty. Smarty invests $10,000 per year in his Roth 401k, where his money grows tax-free. Dummy, that's the other guy, invest $10,000 per year in a regular brokerage account at a place like Schwab or Fidelity. They both invest in the same thing that earns them 10% per year. Both investments will grow to an amazing $3.29 million. That's the power of compounding interest. But there's one key difference. Smarty gets to keep all of his money since it grew tax-free. If we assume a middle-class 25% tax rate, Dummy would owe the government over $732,000 in taxes. That's more than double the $360,000 that he contributed over the years. The only thing Smarty did differently was put his investments in a Roth 401k account instead of a regular taxable account, and he saved over $700,000. That's why this is so important. And we're not even factoring in any employer match in the 401k at their company. This isn't tax related, but if your employer matches your contributions, taking advantage of those is probably the smartest investment decision you could ever make. For a simple example, let's say your company matches your contributions up to 3% of your salary. If you put in $100, they put in $100. You've now made a $100 contribution and you have $200 of investments. It's an instant guaranteed 100% return. Unless you're in a very unique situation like you really need the money immediately or you're about to leave your company so won't be able to keep their contributions, you'd be crazy not to take it. Okay, so let's say you've maxed out your contributions to tax advantage accounts like your IRA and 401k. The second way to reduce taxes on your investment gains is to use ETFs instead of stocks or mutual funds. ETFs are just investment vehicles. They either have a professional portfolio manager choosing investments for you or track an index, the same as mutual funds. There are some other minor differences like the ability to trade them in the middle of the day, but the main difference versus mutual funds is their tax advantage. When you sell an investment for a gain, you pay capital gains tax. For most people, it's 15%, but it depends on how much money you make. But with mutual funds, even if you don't sell them, the portfolio managers are buying and selling stocks on your behalf. So they often distribute capital gains along the way that you have to pay taxes on. Most people smartly choose to automatically reinvest their capital gains, so they don't really notice they ever got them, but for tax purposes, it's like you sold a little bit of your investment and then reinvested the proceeds. You still owe capital gains tax on the money you received, even if you automatically reinvest it. By contrast, ETFs rarely distribute capital gains, so they allow you to defer more of your taxes and ultimately keep more of your gains over the lifetime of your investment. The tax savings come from the fact that mutual funds make you pay more taxes along the way, and that money could have been reinvested in an ETF. So let's take an example of a hypothetical mutual fund and ETF that track the same index. These are essentially the same, except for the taxes. We'll assume the same 2 people from the last example, Smarty and Dummy, invest the same amounts at the same times and earn the same 10% return to keep it consistent. This time, Dummy's mutual fund pays out a 1% capital gain every year, and he has to pay a 15% tax rate on those gains. The ETF doesn't pay out any capital gains along the way, so Smarty can take that same amount of money that Dummy had to pay for taxes and invested it in the ETF. Starting at the bottom, you can see from the darker blue bar that Dummy's mutual fund grew to the same amount as in the prior example before taxes. Smarty's ETF grew almost $130,000 more because he was able to invest that extra money into it along the way. However, remember, ETFs only allow you to defer taxes, not avoid them. This is a common misconception. So Dummy paid more taxes along the way in his mutual fund, but Smarty pays more taxes at the end in his ETF. Even still, you can see from the green and red numbers that after they both sell all their mutual fund and ETF shares to buy their retirement homes or whatever they decided to do with the money, Smarty ends up with over $27,000 more. Now, that may not sound like a lot compared to our first example, but it's almost 3 years worth of their contributions. And what did Smarty do to earn that? Did he do any extra work? No. Did he take any extra risk? No, he simply entered a different ticker symbol. For most mutual funds, especially index funds, there's usually an ETF that's either the same or very similar. So if you're investing outside of a retirement account, it's a good idea to look for those and use them if they're available. Now, for actively managed mutual funds, you're less likely to find an exact replica as an ETF, but sometimes you will, and they usually pay higher capital gains. So the tax savings would likely be higher than what I showed here. The third strategy to minimize the taxes on your investments is to avoid paying short-term capital gains. When you sell an investment after holding it for less than 1 year, the tax rate you pay on your gains is your income tax rate. So in 2023, that's up to 37% for high earners. You might also pay state income taxes on them, but that differs by state. So I'll focus on federal taxes here. If you hold the investment for more than 1 year, you pay a special capital gains tax rate on your gains, which is either 0, 15, or 20%, depending on your income level. For the vast majority of investors, it's 15%. So let's imagine you're not married and you make $250,000 per year. You make an investment that earns you a 20% return over the course of 11 and a half months. If you sell it, you have to give away 35% of your profits to the government. So you didn't really make 20%. You only made 13% after taxes. If instead you waited 2 more weeks to sell it and it was still up 20%, the tax rate on your gains would go down from 35% to 15%. So you'd make a 17% profit after taxes. If that was a $10,000 investment, and that's a $2,000 pre-tax profit from your 20% gain, it'll be the difference of paying $700 in taxes versus $300 in taxes. You can literally cut your tax bill in half by avoiding short-term capital gains. If you're like me, managing your own investments, and you have multiple buy and sell dates that aren't always 11 and a half months ago, how do you implement this in practice? If you have more than one purchase date and you're not selling all your shares at once, there are 2 things you can do when you sell to minimize your taxes. First, check when your purchase dates were. And second, determine which shares to sell. It may be different on different sites, but when you go to sell, you should see an option to choose first in, first out, or last in, first out. This is what it looks like on Schwab when you go to sell something. If you have some shares that were purchased more than 1 year ago, you want to choose first in, first out, because then the first shares you bought will also be the first ones you sell. And you've owned those shares for over 1 year. Therefore, they qualify for the long-term capital gains tax. If you added to your position 6 months ago, selling those shares would result in higher taxes. On the other hand, if you don't have any shares that you've held for over 1 year, you should choose last in, first out, and sell the most recent shares you bought first. That's because you're going to pay short-term capital gains tax either way, but the remaining shares that you're not selling will be closer to the 1 year mark, increasing your chances of lowering the taxes you'll pay when you eventually sell them. It's the same if you're selling at a loss instead of a gain. You'd want to choose last in, first out to sell the newer shares first and give yourself a better chance at paying a long-term capital gain when you sell the remaining shares, assuming they've swung back to a profit. Of course, if you only have one purchase date or you're selling all your shares at once, then the LIFO/FIFO option you choose won't make a difference. But for active traders that added positions on weakness or trim on strength, this is another way to save a significant amount of money on taxes with a simple click of a button. By the way, besides taxes, for most people, it's generally not advisable to do too much trading. People get caught up in headlines, let their emotions of fear and greed take over, and that often leads to poor investment decisions. As I always say, your portfolio is like a bar of soap. The more you play with it, the less you have. The fourth strategy to minimize the taxes on your investments is to invest in municipal bonds. This one is specific to fixed income, aka bond, and is more applicable to investors in high tax brackets. But it can make sense for everyone or no one, depending on the time. Let me explain. When you buy any kind of a fixed income investment like a bond, savings account, CD, or money market fund, including mutual funds and ETFs that invest in those things, your coupon payments or dividends will generally be taxed at whatever your income tax rate is. However, in most cases, municipal bonds are federally tax-free. And if they're issued in the state that you live in, they're also usually state income tax-free. For a high earner in California, that can be over a 50% combined tax rate. But it's different for everyone, so here's how you determine if it makes sense for you to invest in municipal bonds instead of taxable bonds. First, you have to find the yields on equivalent treasury and municipal bonds, or 2 different bond funds or ETFs that you're deciding between. A quick Google search pulls up this chart from Raymond James, which shows the yields on treasury bonds in red and the yields on municipal bonds in black. AAA municipal bonds usually pay a lower interest rate than treasuries because of these tax benefits. But the tax benefits are more valuable if you have a higher tax rate, right? So to compare the numbers, you need to calculate the tax equivalent yield, which just means the yield you'd have to earn on a taxable bond to end up with the same amount as the municipal bond after taxes. To do that, you divide the municipal bond yield by 1 minus your tax rate. So, for example, a 1-year treasury bond pays 5.41%. A 1-year municipal bond only pays 3.81%. But if you divide that by 1 minus 0.35, you get a tax equivalent yield of 5.86%. You can see from this simple table that you'd make more money in municipal bonds if you were in the 32% tax bracket or higher, and more money in treasuries if you were in the 24% tax bracket or lower. You can do this same calculation for any 2 taxable versus municipal bond investments you're considering, and use your own tax rate, including any state income taxes you might also have to pay. Another way to do the comparison will be to multiply the taxable bond yield by 1 minus your tax rate. So your 5.41% treasury yield, if you have to pay 35% taxes on it, is really only a 3.52% yield after taxes. That's not as good as the municipal bond, which is paying 3.81%. Let's recap. The 4 keys to minimizing the taxes on your investments are: number 1, take advantage of tax advantage accounts like 401ks, IRAs, and 529 plans. Number 2, use ETFs instead of mutual funds if there's a duplicate option. Number 3, try to avoid paying short-term capital gains as much as possible. And number 4, use municipal bonds instead of taxable bonds if you can get a higher tax equivalent yield in them. Last thing here, if you have any investment related question you'd like to get my help on, you want direct access to me, you can join my free Discord by checking out the link below in the description. Thanks for watching.